Welcome to DataServicer YouTube channel. I'm thanking for this day and wishing you all the best for what you do today and in future. So in this video, I'm going to discuss about standard deviation, alpha and beta, which are some of the important metrics that need to be checked before investing into the mutual fund. These metrics are rarely available in investment apps. But you know what? These metrics helps you a lot from losing your money from investing into some bad funds. Most of the investment apps shows about the returns and past performance, but very few provides about the numbers of standard deviation, alpha and beta. We have collected these numbers from various sources and did the consultation and providing it to you along with the explanation about these metrics. Standard deviation. We have came across this term in mathematics statistical portion and we knew that standard deviation is a measure of the amount of variation or dispersion of set of values. Say for an example, ABC mutual funds provide 15% returns, and if the standard deviation is 7%, then we should be aware that we may get either 8%, which is a lower bound, or 22%, which is a higher bound. This is simply calculated by return minus standard deviation and return plus standard deviation. These metrics have been calculated based on the past performance during the market fluctuation, and this is how standard deviation comes into picture. So whenever you see an information about a particular mutual fund whose returns are expected to be some 10 or 15%, check for the standard deviation and then revise the return percentage mentioned and think it of whether it at least meets your expected return percentage or not. If a particular mutual fund is providing 15% but you want the average return to be 20%, then you have to check for a mutual fund whose returns should be 25% or more. And if the standard deviation is 5%, then it exactly meets your expectation. So 25 minus 5% will give you 20%. So this is how you have to check for the standard deviation of a particular mutual fund before investing into it. The next metric is alpha. This is also a term we would have come across from mathematics and stats, but how it defines and differs with mutual fund is important. Alpha is nothing but measure of risk adjusted performance of your investment. Alpha is based on the benchmark and the number is calculated from it. Say for an example, if the benchmark is Nifty Equity Savings TRI and if the Nifty Equity Savings TRI that has given a return of 20% in a specific year, and if the given value of alpha is plus 2.0, then it means that the benchmark Nifty Equity Savings has outperformed its benchmark index by 2% and it has given 22% as returns for the specific year. Similarly, if we see a negative alpha that is minus 2.0, then the Nifty Equity Savings TRI has underperformed and it gives returns 18% for that specific year. Alpha also plays an important role in mutual fund, so check for the alpha numbers before investing into it. The next metric that we're going to see is beta. Beta describes the sensitivity of the mutual fund towards market movements. It is advised that the beta of the market or benchmark is considered to be 1. Any beta less than 1 describes lower volatility and higher the 1 describes the more volatility compared to the benchmark index. Example, if the mutual fund portfolio ABC has a beta of 0.70, it describes lower volatility. This means that for every rise or fall in the market, the value of ABC may rise or fall by 0.70, not the 1, that is 100%. If you want to invest in mutual fund whose risk falls between low to medium risk profile, then you should look at funds having a lower beta value. That's it I have for this video. I'll come up with another learning part in the next video. Notes related to standard deviation, alpha, beta is available in my FundsLearning window. For queries and concerns, you can mail us to yourdataservicer@gmail.com. Follow us on Insta, Telegram and LinkedIn for frequent updates. Stay notified and stay subscribed for more data.